Hello, this is Mark Starosiak, Managing Partner with Infinium Investment Advisors. You've tuned into our market update for the end of 2015 and look ahead for 2016. As a reminder, anything we talk about here today is purely for informational purposes, not intended to be a recommendation to buy or sell securities or follow any investment strategy. We do not provide tax and legal advice. Please always consult your own financial advisor before making any investment decisions. Okay, so just a bit of a recap here, 2015. We said at the beginning of the year last year it was going to be the year of mush. And that was sort of a cute way of saying we thought the market forces would sort of negate and sort of cancel each other out and we'd end up neutral. And lo and behold, the markets were down less than 1%. If you look at the S&P 500 in 2015, we're up as much as 4.5, down in the 8% range. And when we, sort of came through it all, it finished, right about where it started the year. So there were some things that actually did very well in 2015, and these are areas of the markets that typically most investors don't know about, and even the so-called professionals don't spend a lot of time in or don't have the experience with. Well, those are areas that we actually do delve into for our clients in the right situations. But, the point is something is working out there typically. You just have to know where to find it. So one of the very successful areas for us last year was long short commodities. And you can imagine it was a lot more short than it was long because commodities just sort of continue to fall out of bed. In the space that we use, we allocate funds, that was up over 20% last year. And that was an easy one when you started to look at, what did gold do? What did copper do? What did, all the energy, the energy complex, oil, natural gas, etc. All that was in a significant downtrend. And folks, when you're looking at how to make money in the markets, how to diversify your risk, many of these funds in this area that we call alternative investments, they just need trends. Doesn't matter if that trend is up or down. So you want to sort of get away from this idea that, you want to be fully invested in stocks all the time. I think we all inherently know that it's probably good to be a little bit light on stocks sometimes, or maybe even a lot light. But nonetheless, there are areas of the market that are working. Just got to get out there and find them. There are funds that actually play volatility out there. And we know that volatility has picked up from a very historical low. And that was an area that you could have made a decent rate of return as well. The fund that we use in that particular area was up almost 8%. Again, S&P 500 was down a little less than 1. So again, you need diversifiers if you're going to try to, handle this type of market and give yourself at least the chance of a decent return. So at the beginning of 2015, we said the short term was going to be very extremely volatile, and I think we got that right here. And then on the intermediate term, we said it was very sideways, and long term, it was a little hard to determine. So at this stage, in 2016, as we begin, it looks like the short and intermediate term are pointing down. We would not be surprised if our year-end update in 2016 and look ahead in 2017 is decidedly negative. So at least that's what the market's telling us right now. Now, we do want to open up the possibility that we get a surprising rally. And the reason I say that is over the last several months, there's been an extreme amount of negative sentiment out there, both from professionals and the general investing public. And typically that's not, you don't see that type of negative sentiment around the markets and the economy, etc. You don't see that at the beginning of a big downturn. Typically that's what happens at the end of downturns. So we have to, sort of look at what's going on in the marketplace, say how people are reacting to it. And I think you got to leave open the possibility that the market somehow, something happens to bring it up and surprise people to the upside. We'll talk a little bit about that in coming slides. But if I were to sort of handicap this, I'd say there's probably an 80% chance we finish the year down based on what we see today. and maybe a 20% chance that markets surprise us. And everyone who's been so negative, which is a lot of people, end up being surprised. So we think the long term at this point is still intact. The short, intermediate term seem to be pointing down, but long term we're not at at a big risk that's we're in some major downtrend. We just don't see that at this point, but certainly the year or less, it looks like things are pointing that direction. So what we're calling it, at least at this point, our base case is that the stock market is stalling and maybe rolling over. We're calling it the DBTC market. It's the death by 1,000 cuts. And we say that because, again, you typically don't see 20 and 30 and even more percent downturns in the market when people are this negative. Typically just doesn't happen. And when they're this negative, that means they're being conservative. They're holding extra cash. You typically don't see big downturns when people are sort of positioned that way, professionals and individuals alike. So this is a chart here the last 5 years on the S&P 500, and you can see the trajectory here. It's just sort of run out of steam. Now we've recovered a little bit here today and recaptured a level in the markets that we think is very important. That is this low that was made approximately here. This is August of 2015, was about 1876 on the market. Now this is old, 1890. I think we closed in around the 1870 today on the S&P. But the 1867 in around that range is sort of the line in the sand. So if we can hold this low that was made in August of last year, we're in pretty good shape. But by the same token, we need to get through this, top part. So, just yesterday, and today is Thursday, the 21st, just yesterday we broke through that 1867 mark on the S&P 500, and that was very negative for the markets. Again, we've since recaptured that here today, which is a positive. But the market is really, it's interesting to watch it sort of fight that battle in and around that low that we made back in August of 2015. So to be in an uptrend, a well-defined and identifiable uptrend, we need to hit a new high. So that is about 2134 on the S&P 500. If we don't break that, we are stuck in a range, and that range being that 1867 to 2134. We've been there for quite some time, and until the market definitively breaks through that, let's say on a weekly closing basis, you're just stuck in a range, and it's really hard to tell what's going on. So those are the key points I want you to just continue to watch. Two, sort of what has us concerned in the marketplace, and just what we see going on, is it seems like deflation is actually coming, and this makes sense, right? Because over the last 4, 5, 6 years, the big talk was inflation, all this money printing and what have you. But that's not what the marketplace is telling us. It's telling us something exactly the opposite. It's showing us deflation. And part of that is what we see in commodities. Again, we mentioned some of the hard metals, energy, all these things are seemingly pointing down. Now, there are some places where, yes, there is inflation, housing, etc., but we could think that, is in somewhat of a mini bubble, frankly. But nonetheless, if you look at commodities and commodity prices, those are telegraphing a significant slowdown in the economy. So the question is there growth enough to support all the debt that we've, created in the last several years, all these government buying programs and bonds and keeping interest rates artificially low, etc. Is there indeed the growth to service all that new debt? And so a part of that problem is China. I mean, China has been growing, in the 7 to 12% range for a very long time. And if you do the math, assets or growth of anything typically doesn't last that long at that pace. So you have the centralized government in China controlling things, and typically we've seen over the years how that ends. It doesn't end well. Free market forces have a way of creative destruction and solving inefficiencies. Centralized governments have just the opposite track record. And so what we're seeing is China is starting to weaken significantly, and they may very well devalue their currency. And if that happens, the U.S. Probably looks like a better place. The dollar probably strengthens. And if you follow the reasoning here, if the dollar strengthens, commodities fall. They continue to fall because the commodities are denominated in U.S. dollars. So I think that's going to be one of the big challenges out there. If you hear some of the really smart money, the smart money managers out there, they are concerned about this. Now we don't, tend to pay too close of attention to this because we can't analyze it better than the next person. But nonetheless, it is one sign to us that deflation may indeed be here. So taking it one step further and sort of looking what's going on here and why we are negative on real estate is that we think people have overinvested in real estate again. Is it going to be a subprime financial crisis again? No. Typically the bubbles don't repeat themselves. They might do it in just a little different form, but they're not going to exactly repeat. But what we do see is, if inflation or deflation is indeed in the system, owning hard assets is not a good thing to do. Again, we'd say that housing and the strength that it's seen in the last several years in particular are a sure sign that probably people have over-allocated to real estate again. And what's the one thing that would really hurt people who own and who are leveraged into hard assets? That is deflation. So remember, markets move to hurt as many people as possible, as much as it can. Markets are unforgiving from that perspective. So just look around you. If you see all these cranes in the air and you see real estate prices, sort of going up, and it just doesn't seem to make sense, it doesn't feel right, this is how it feels to us, then there's a problem there. So you ask yourself, well, how can these people who've over-allocated to real estate, and we're talking commercial and residential across the board, we think there's been an over-allocation of capital into real estate again, and something is going to solve that problem. Deflation would be, sort of high on our list of things that can come along to derail that big run that we've seen again in real estate. So, given this negativity, the question is, how do you combat a potential down market and deflation? Well, you look back at the alternatives, and we talked about this beginning of 2015. We said, take a look. If the markets don't do anything, you need something in your portfolio that can, and alternative investments are that thing. So according to Morningstar, one of those alternatives you could consider would be managed futures funds. Those have risen, close to 4% this year in a market that's off around 10. So, again, it gets back to the idea there are parts of the market that are working. You just have to look for them. So managed futures strategies tend to just need those trends. They tend to do very well in bad stock markets. So the differential there is what, 14%, something like that. Now it's hard to say where things will end up, of course, but nonetheless, for folks who've invested in this part of the market, they've seen some not only great protection against the downturn, they've actually made money. So, we highly encourage you to take a look at what we call alternative investments, liquid alternatives, managed futures, etc. Don't make any decisions. Don't rush headlong because there are many flavors of these types of funds. Get professional help, someone who knows what they're talking about, has experience in this space. But we absolutely think it warrants consideration, especially if we're right on our down call. So in conclusion, we think it's a death by 1,000 cuts market. We don't see a big drop, yet we see something that's probably more frustrating to investors and certainly not very profitable. Deflation, we're saying take a look at selling hard assets, physical stuff that you have, real estate, extra vehicles, collectibles. All these things have done very well in the last several years, probably too well. And so the thing that comes along that could really hurt hard assets, things that you own, physical stuff, would be deflation. So highly consider liquidating some of those if you don't need it, don't want it, etc. And then again, consider alternatives. You need, in our view, a diversifier, true diversifier to get you away from, needing a good stock market to make money. So alternatives have the tendency to go, to do very well in bear markets. They can make money in bull markets, and they also can do well in neutral markets. With that, I'm Mark Starosiak. Hang in there, and we'll see you next month.